investors, my name is Irvana, and today my team and I are going to present our investment analysis for PT Japfa Comfeed Indonesia.
Our presentation today will cover several topics in which I, Irvana, will talk about Japfa's business overview, the financial forecast along with the underlying assumptions, and also the performance forecast. The second presenter, Alifah, will explain about the equity valuation in which we use the discounted cash flow method and the discounted dividend model. And the last presenter, Dewi, will talk about the financial distress analysis, debt valuation, and other qualitative considerations. So, without further ado, let's get started. PT Japfa Comfeed Indonesia, abbreviated as Japfa, is one of the biggest agri-food company in Indonesia. Its parent company, Japfa Limited, is based in Singapore. Japfa's business segments are divided into 6 operating segments, which comprise animal feed, day-old chick, commercial farm and consumer products, beef cattle, aquaculture and trading, and others, with a breakdown of revenue per segment as follows. With those 6 business segments, Japfa also become a company with an integrated upstream to downstream business lines. This also becomes Japfa's competitive advantage compared to other industry peers.
So, before we begin with the forecasting assumptions, let's start with the revenue and earnings behavior. Japfa's revenue showed a positive trend in 2015 to 2018, whereas its earnings fluctuates and shows no specific trend. The high earnings back in 2018 was achieved by efficiency efforts done by Japfa's management through adding capital expenditures and increasing capacity. The fact that the poultry industry was particularly thriving also increases the sales growth in that year. The first assumption I'm going to explain is about the sales growth rate. Although Japfa incurred a promising sales growth rate of 14.9% in 2018, due to the sales decline in Q3 of 2019, we forecasted that sales growth will slightly decline into 11% in 2019, but will continue to increase by 1 to 2% per year in the years afterwards. These forecasts were made with some considerations as follows. Indonesia's population is predicted to grow in the next 5 years, and poultry is the main protein source for almost 65% of Indonesians. Japfa still has the potential to grow further as it operates in all major animal protein sources, such as poultry, cattle, and fish, and also considering the fact that Japfa is currently the second largest market share in the poultry industry, we are optimistic that this level of sales growth is attainable. The high and stable economic growth in Indonesia also contributes to our forecasted sales growth, as this translates to a higher income per capita and private consumption. The second assumption that I'm going to explain is about NOPAT margin. We believe that Japfa will incur an increase in its net operating profit after tax. Consequently, although its sales growth will decline, its net operating profit after tax will increase. There are several factors that contributed to the changes in Japfa's margin, such as SGA expense, other operating expense, foreign exchange currency, input price, and effective tax rate.
The breakdown of our NOPAT margin assumptions are shown as follows. We assume that there will be a slight decrease in SGA expense, since in the prior year Japfa has already increased its operating expense to support the improvements in the company's performance. Japfa's feed division uses various main raw materials such as corn and soybean, which contribute 70 to 75% of livestock feed materials. We assume that the price of corn and soybean will increase due to the declining of global production level and long dry season in 2019, hence the increase of input price in 2020 and beyond. The changes in exchange rate will also directly impact Japfa's profitability since it imports some of its raw materials in foreign currencies. In 2019 and beyond, we assume that rupiah will be appreciated against US dollar. Thus, the foreign exchange rate will only affect 2.1% of NOPAT margin and 3.9% afterwards. In addition, We assume that there will be no significant changes in Japfa's other operating expenses and that its effective tax rate remains steady.
The third assumption that I'm going to explain is about the operating working capital to revenue ratio. Due to Japfa's operating working capital growth and its ambitious expansion and increasing capacity plan, we believe that Japfa's operating working capital will continue to grow steadily. But we are under the assumption that operating working capital will not grow in the same rate as revenue and will continue to slightly decrease based on the decrease of OWC to revenue by 0.87%. The next assumption is regarding non-current assets to revenue. So, as Japfa operates in an industry that is capital intensive, its capital expenditure will change throughout the years due to expansions or even just to maintain its operations. In 2019, Japfa incurred a capital expenditure of 3,000 billion rupiah to build new plants, warehouses, cages, and others. Adding that amount of capital expenditure and then adjusting with the related depreciations, we arrived in the non-current asset balance in 2019. Historically, Japfa also has spent a considerable amount of capital expenditure in 2018, which resulted in significant increase in its revenue. As such, we concluded that in order to maintain the level of growth as previous years, Japfa will need to maintain its current level of non-current assets to revenue. We forecasted that in 2020 to 2023, the ratio would be 27.72%, which is derived from the average non-current assets to revenue ratio. Our last assumption is regarding capital structure. Japfa's average debt to capital ratio was 47.55% in 2015 to 2018. As short-term debt is one of Japfa's main financing sources, we use the assumptions that their debt will increase in 2019 in that same ratio. Shareholders' equity will continue to grow as a result of increase in net profit in the year afterwards, which will increase retained earnings. We do not have the assumption that Japfa will issue preferred shares or additional common shares, and use the assumption that its dividend payout ratio and interest expense after tax will remain constant. Those forecast assumptions were then comprised in the summary as follows.
After constructing all the underlying assumptions, we came up with the beginning condensed balance sheet as follows. Both business assets and capital balance will have an increasing trend up until 2023, with increases in operating working capital and net non-current assets causing the most changes. As for its condensed income statements, both net business profit after tax and net profit will have an increasing trend up until 2023, due to the assumptions that we have previously explained about NOPAT margin. And lastly, for the condensed cash flow statements, Japfa's free cash flow to equity is forecasted to be positive and increasing up until 2023, whereas its free cash flow to capital is forecasted to be negative in 2019 due to Japfa's expansion plans which were funded using debts, but it will gradually increase in the years afterwards. Now, I'm going to explain about Japfa's performance forecast. Japfa's projected abnormal ROE will increase from 12.68% in 2019 to 13.93% in 2021 and will gradually decrease in the years afterwards. All other measures also shows the same steadily increasing trend except for its free cash flow from operations, which fluctuates greatly. Although we calculated and disclosed the performance forecast for asset valuation, we will not be using asset approach in calculating the valuation of Japfa. Next, my friend Alifah will explain about equity valuation.
For calculating the cost of equity, we use the capital asset pricing model, which uses three inputs. For the risk-free rate, we use the Indonesia's 10-year government bond yield, which is 7.01%. For the market return, we calculate the 10-year annualized average of Japfa's historical trends. We calculated the beta equity of Japfa by regressing the daily changes in Japfa stock price with the changes in Jakarta Composite Index price in the past 5 years. We came up with an equity beta of positive 1.1797, which means that an increase in market return of 1% will increase Japfa's return by 1.197%. So, Japfa's cost of equity or required rate of return is 10.3%, and we will use it to discount the Japfa's free cash flow for the valuation. For Japfa's weighted average cost of capital, we calculated the average of Japfa's cost of debt and cost of equity. Japfa's cost of debt is 10.31%, and Japfa's cost of equity is 10.30%. So, Japfa's weighted average cost of capital is 9.36%. There are three inputs used to calculate Japfa's beta asset. The first one is Indonesia's tax rate, which is 25% for its corporate income tax. The next one is Japfa's beta equity, which we have discussed earlier. And the third one is Japfa's average debt to equity ratio for the past 3 years. So, Japfa's beta without taking into account its debt, or also known as beta asset, is 0.6. Next, I will explain to you about the discounted cash flow valuation for Japfa. So for this valuation, we use several inputs which were calculated before. Those are the risk-free rate, the market return, the beta equity, and the required rate of return. For the stable growth rate of 3.5%, we calculated the average of Indonesia's GDP and inflation rate. Japfa's outstanding shares for the end of fiscal year 2018 was about 11 billion shares. According to our calculation, Japfa's value per share or its intrinsic value is 1,084 rupiah. So we concluded that Japfa's share price is undervalued compared to its share price per 12 December 2019. We issue a buy recommendation for Japfa with a potential upside of 25.98%. Next, I am going to explain our dividend discount model valuation for Japfa. There are three main inputs for this calculation. The first one is earnings per share. The second one is the average dividend growth rate, and the last one is the average dividend payout ratio. We forecasted Japfa's earnings per share for the next 5 years by multiplying the actual earnings per share of 2018 by the average dividend growth rate, which we use on our assumption. For the average dividend growth rate, we assume it will be constant for the next 5 years of 12%. The average dividend payout ratio we assume to be stable also for the next 5 years. The average of 47.06% is the average of the last 3 years of its dividend payout ratio. Based on our calculation, we concluded that Japfa's intrinsic value is 1,962 rupiah. So Japfa's share price is undervalued, and we issue a buy recommendation with an upside potential of 24.62%.
Thank you, Alifah. Now, my name is Dewi Anis, and I will explain our analysis about financial distress, debt valuation, corporate governance and risk management, and future plans.
The first topic that we are going to discuss is financial distress. We use Altman's Z-score model to analyze the financial distress of Japfa. The model predicts bankruptcy when Z-score is less than 1.81. The range between 1.81 and 2.67 is labeled as gray area. Japfa's Z-score increased from 3.6 in 2017 to 3.9 in 2018. Therefore, Japfa has no indication that it is under financial distress leading to bankruptcy, since in Japfa Z-score is above the gray area, and Japfa is less likely to be distressed than in the previous year, since its Z-score in 2018 is greater than previous year. The second topic that we are going to discuss is debt valuation. Based on the calculation of bonds valuation by discounting Japfa's bond with discount factor based on bond rating, Bonds valuation is 2.3 trillion rupiah, while its book value is 2 trillion rupiah. Senior notes valuation is 263 million US dollar, and its book value is 250 million US dollar. Overall debt valuation shows that the value of present value of bond is greater than its book value, although it is not significantly different.
Now, I'm going to discuss about Japfa's future plan. Japfa has good financial performance seen from its high Z-score around 3. Therefore, we recommend Japfa to continue its business expansion as was done in 2019. We recommend Japfa to expand its production capacity through the construction of new factories, warehouses, and silos, so that Japfa can reach the economics of scale and make its operation more effective and efficient. In the prior years, Japfa is involved in acquisition of companies in the same sectors in order to increase their efficiencies in supply chain management through vertical integration by acquiring suppliers. We do not recommend Japfa to add its business line for now, as Japfa already has many types of diversified business lines ranging from animal feeds, production breeding, commercial farming, and processing regarding poultry, aquaculture, and beef cattle. As their business life cycle has already reached a mature stage, Japfa has limited upside growth potential and would not be attained by M&A action. We recommend that Japfa should continue to grow organically by expanding their geographical distribution and increasing production capacity.
Now, let's talk about the corporate governance and risk management. We will talk about corporate governance implementation, also risks faced by Japfa and how they control the risk through risk management system.
In 2018, the company has improved its corporate governance implementation mechanism by improving the mechanism of board and commissioner meetings, board of director meetings, and joint meetings with better administration recording. Furthermore, the company has also intensified the role of risk management in managing risk by performing a number of preventive mitigation plans. We should know that inherent risk faced by poultry farm is disease that might attack their livestock. Disease outbreak at the upstream will be greater impact to the downstream and potentially result in loss of Japfa. In order to minimize this risk, Japfa specifically produces livestock vaccine through PT Vaksindo Satwa Nusantara and applies strict biosecurity measures. The livestock vaccines production provides benefit to Japfa in terms of cost efficiency, which prevents economic losses. Another risk they may incur, including availability and price fluctuation regarding raw materials, such as soybean and corn as raw materials for livestock feeds. To minimize this risk, Japfa provides intensive coaching to the local farmers to be able to produce high-quality products. Therefore, their product can be utilized as the source of raw materials for Japfa's productions. Government regulation is one of the risks that cannot be controlled. Therefore, Japfa continuously strives to adapt to the government regulation. In running its business activities, Japfa also embraced the principle of transparency, accountability, responsibility, independence, and fairness. Another new challenge faced by poultry industry in Indonesia is regarding regulation on chicken imports from Brazil. In 2019, Indonesia has lost the chicken import dispute with Brazil at World Trade Organization session begin in 2017. Therefore, Indonesia cannot refuse to import chicken from Brazil, and this condition might cause an oversupply and reduce the chicken's price by next year, and might decrease the poultry company's revenue also. Therefore, investors should consider this condition also.
So, that's all from us. Please let us know if you have any comments or feedbacks. Thank you.